Welcome to our guide on investment evaluation. Understanding the importance of evaluating investment returns is crucial in the world of finance. Whether you're looking at stocks, bonds, or real estate, knowing how to effectively assess potential returns can make all the difference. In this video, we will delve into common methods used in finance to evaluate investments, starting with the fundamental principles. Investment evaluation is not just about crunching numbers. It's about making informed decisions that can impact your financial future. We'll explore the limitations of traditional methods and introduce sophisticated techniques like the discounted payback period. By the end of this video, you'll be equipped with the knowledge to make smarter, more reliable investment decisions. Stay tuned as we dive deeper into the complexities and nuances of investment evaluation and get ready to take your financial acumen to the next level. Let's embark on this journey together. Traditional payback period methods often fall short when evaluating investments. This approach ignores the time value of money, a crucial factor in financial analysis. By overlooking how the value of money changes over time, traditional methods can lead to inaccurate evaluations and misguided investment decisions. Imagine assessing a project's viability without considering inflation or potential interest growth. These shortcomings highlight the need for a more precise approach. As we move forward, you'll see how the discounted payback period offers a solution. After identifying the limitations of traditional methods, it's time to explore a more robust approach, the discounted payback period. This method considers the time value of money, providing a deeper insight into investment returns. By incorporating the time value, it remedies the primary shortcoming of the traditional payback period, which often leads to inaccurate evaluations. Using discounted cash flows, this approach offers a clearer picture of how soon an investment will repay its initial cost. Now let's break down the steps and understand the calculations involved. Let's break down the calculation of the discounted payback period step by step. We'll cover 4 essential steps. First, identify the cash flows associated with the investment, including both inflows and outflows over the investment horizon. Next, determine the discount rate. This rate reflects the time value of money and the risk associated with the investment. Selecting an appropriate discount rate is crucial as it directly impacts the present value calculations. In the third step, calculate the present value of each future cash flow. By discounting these cash flows back to their present value, we can better assess their true worth in today's terms. Finally, determine the payback period. This involves summing the discounted cash flows until we reach the initial investment amount. The point at which the cumulative discounted cash flows equal the investment is our discounted payback period. Each step is fundamental in providing a more accurate measure of the investment's return, making it easier to compare and evaluate different opportunities in a consistent framework. As we move forward, you'll see how to apply these steps to a real-world example, ensuring a comprehensive understanding of the discounted payback period. Let's apply these steps to a real-world example. Imagine you're evaluating a project with an initial investment of $10,000 and anticipated yearly cash inflows of $3,000. The chosen discount rate is 5% per year. First, we'll identify the cash flows, $3,000 for each year. Next, we need to determine the discount rate. Here it's 5%. Now let's calculate the present value of each year's cash inflows. For the first year, the present value of $3,000 is calculated as $3,000 divided by 1.05, which is approximately $2,857. For the second year, it's $3,000 divided by 1.5 squared, resulting in about $2,720. Similarly, we compute the values for subsequent years. As we proceed, we sum these present values year by year, comparing them to the initial investment of $10,000. By the end of the fourth year, the cumulative present values surpass the original investment, reaching just over $10,000. Thus, the discounted payback period is slightly less than 4 years. This tells us that it takes nearly 4 years for the investment to break even when considering the time value of money. Now, let's interpret these results. The discounted payback period of almost 4 years indicates a moderately quick recovery of the investment, factoring in the discount rate. This helps you make an informed decision about whether this project aligns with your investment criteria. As we move forward, we'll explore the advantages of using the discounted payback period method over traditional approaches. The discounted payback period offers significant advantages over traditional methods. By accounting for the time value of money, it provides a more accurate assessment of an investment's return. This method ensures that future cash flows are appropriately discounted, reflecting their true present value. This leads to more precise and reliable investment evaluations, helping you make informed financial decisions. Unlike the traditional payback period, the discounted method addresses the inherent limitations of ignoring the time value of money. Next, you'll see how this method compares with others like NPV and IRR, further solidifying its role in investment analysis. While the discounted payback period is a valuable tool in financial analysis, it does come with notable limitations. One major drawback is its inability to account for cash flows that occur after the payback period. This means potential future gains are overlooked, which can lead to incomplete evaluations. Additionally, this method might not be appropriate for all investments, especially those with long-term growth potential. Investors need to be mindful of these limitations when choosing the best method for evaluating their investments. Next, you'll see a comparison with other methods that might provide a more comprehensive view. Let's compare the discounted payback period with other popular investment evaluation methods, such as net present value, NPV, internal rate of return, IRR, and the traditional payback period. Each method has its strengths and best use scenarios. NPV measures the difference between the present value of cash inflows and outflows, providing a clear indication of an investment's profitability. IRR focuses on the return rate at which the NPV equals zero, making it ideal for comparing different projects. The traditional payback period simply calculates how long it takes to recover the initial investment, although it ignores the time value of money. Use the discounted payback period for a time-sensitive view that considers the time value of money. NPV is best for assessing overall profitability. IRR is great for comparing different investments' returns rates, and the traditional payback period works well for a quick, straightforward analysis. Next, you'll see how to apply these methods in practical situations. Here are some practical tips for applying the discounted payback period method. First, always use an accurate discount rate. It makes a significant difference in your calculations. Forecast cash flows cautiously and validate the accuracy through multiple sources. Typical pitfalls include ignoring future cash flows after the payback period and underestimating the time value of money. Consistently update your data to reflect real-time information, as outdated figures can lead to erroneous results. Finally, practice these applications using varied scenarios to sharpen your analysis skills. Mastering this method will give you an edge in investment evaluation. As we move forward, we'll summarize the essentials and draw our final conclusions on this method. Stay tuned. We've covered a lot today, so let's quickly recap. The discounted payback period is a crucial tool in investment analysis, addressing the time value of money to give more accurate evaluations. We've delved into its step-by-step calculation, seen practical examples, and discussed its advantages and limitations. Remember, while it's a powerful method, it doesn't account for cash flows beyond the payback period. Always consider the context of your investment. Thanks for staying with us through this journey into financial analysis. As you continue your studies, keep these insights close at hand. Stay tuned for more in-depth discussions. If you found this video helpful, make sure to subscribe to our channel for more educational content. Keep learning and stay ahead in your finance studies. We appreciate your support and look forward to providing more valuable insights. Take the next step in your journey by joining our community.